Okay, my name is Benjamin. Really apologize for the technical problems that we've been facing over the sound issue yesterday and today. So thanks a lot for waiting for us. All right, so we'll just go on to move on to presenting this week's our weekly call. All right, so first up today we'll give some updates on a couple of companies. Then following that, I'll hand over to my colleague Colin, which will bring you through a non-rated presentation on Yuan-Sang. Alright, so first of all, let's start on Ezra Holdings. Just take note that for Ezra, there's a change of analyst. So currently our call is still undergoing review, but the last call is still neutral. So I don't think this is going to change as well. So the three Q results for the quarter ended 31st May came out recently. So you can see it was another quarter of growing revenue as well as improved core operating performance. All right. We look at the top line wise, revenue has grown 27% Q on Q for this quarter, right? And profit after tax is up 6% year on year. All right. For this part, for the 9 months ended 31st May 2014, although it seems that it's down year on year, but if we do some adjustments to the bottom line, in fact for the quarter as well as the 9 months. Even for the quarter as well as the 9 months, all right, it has actually been up quite a substantial amount because for the 1 year before that, it was actually in the red, right, due to a couple of one-loss after you adjust it, right, for some of the asset disposals as well as some of the AFS realization. Right, so next up will be the stronger performance has been largely driven by the subsea services. So the subsea services side, they have a higher fleet capacity of 2 new vessels, new orders, as well as increased value and number of projects taken. So for the subsea side, about 4 consecutive quarters of profitability. Right, so the order book now is about $2 billion USD, right, to be executed within the next 12 to 18 months. Right, I think the most exciting news was what came out recently, where they are planning to consolidate their marine sector into EOC Limited, which is listed in Oslo. Right, so with this consolidation, I think you can expect net gearing to go down to from 107% to 72%. Right, and this consolidation, right, will create Asia's largest OSV, right, by asset value with their fleet size of more than $1 billion. Right, and take note that EOC is also considering to be secondarily listed in Singapore, right? So if it does go through, it become another OSV play, pure OSV play, just like Porsche as well as Pacific Radiance. Okay, so and Ezra from this consolidation, I think can expand to continue to focus on subsea businesses, while this allows them to take part in the growth for the OSV market. So the transactions will be receiving 150 million in cash and 370 million worth of EOC shares, right? So from there, EOC will become a subsidiary, which is about, I think, ranging between 50 plus to 60% shareholdings in EOC. So they can expect some slight 7 to 8% EPS dilution from this consolidation, right? Next up will be on SGX. This is on the quarterly statistics that came out. So just take note that for 30th June, it's the 4th quarter of SGX results coming out soon in the next couple of weeks. So that will be the full year results. So look at the securities daily average value, the SDAV. If you guys have been monitoring, I think over the last 1-2 months, it has been pretty weak. So, but Q wise, we did see some recovery of about 3.5% to 1.125 B a day. Okay, but the volumes year-on-year wise is still very much suppressed. Your SDV is down 30%. Alright, so market depth is a bit weak. Okay, securities levels are still quite persistently low. So therefore, we've revised our FY15 forecast downward slightly. So derivatives side has contributed about proportionally wise about the same as securities in the last quarter. Okay, so for this quarter, the DDAV has came down a little bit by 8.9%. Okay, year-on-year wise, it has been down 20%. Right, this is from exceptionally strong 4Q last year. Right, based on expectation wise, securities revenue should continue to pick up. Right, even though SDAV has rebounded slightly last quarter. right? But your retail versus your industry mix has improved. So retail takes about 67% currently for all the volumes. So this implies that clearing fees will be higher quarter on quarter, considering that the retail players pay a slightly higher amount, right, than the industry guys. But going forward from there, they have revised the clearing fees, all right, to 3.25 basis points across the board. So the industry guys as well as retail will be paying the same. Right, revenues for the derivatives side could be slightly lacking since the DAV has dropped. So last time it was driven by a few key contracts. So you can see that the China A50 is down 6%, Nikkei 225 is down about 27%. Right, the Nifty is up about 17%. Right, that is because of the India elections. So I guess that there was a bit more interest in the India contracts. So our core is still neutral. Right, our target price has been revised upwards to 7.45 as we roll over our valuations. Just take note that dividend yield is pretty attractive for SGX, but still 4%. Okay, one key thing I would like to note is that they have introduced the market maker liquidity provider program as of 1st of June. So for this, they're bringing in market participants, right? So that depends on which category they fall under, either market maker or liquidity provider. So market makers usually have to provide more commitments as well as subject to higher levels of checks and commitments, right? So for them, market makers can get up to 100% of clearing fee rebates, right? And liquidity providers up to 75%. So I suspect that for these market participants, what SGX is trying to do is bring in, promote the influx of high-frequency traders. Okay, so that in hopes that it can help to boost the liquidity in our market as well as the very suppressed volumes that we've been seeing over the last 1 year. All right, so on the revenue-wise, let's see if this helps to boost the trade volumes. As at this point of time, this has just kicked off. We're not sure, can't really evaluate, and SGX also can't evaluate the real impact on the market for now. But let's just wait and see. Right, so this one is all together with microstructural changes, as just like the reduction of board lot sizes. So for that, they're still sticking by their previous guidance for about the second half of this year. Not very sure, but probably towards the end of 3Q. Right, this when we will see them implementing the reduction of 1,000 to 100 for board lot sizes. Alright, so SGX is still neutral. So from there, I'll hand over to Caroline to talk about Amara.
Hello, morning. This is Caroline. Today we'll do a recap on the Amara price performance. Since our last report on the 16th of May, the price has actually provided a return of about 16% with the last closing on 61 cents on 11 July. Though yesterday it closed slightly a little bit lower at 60 cents. But as you can see, the price for Amara has actually started moving. For Amara, when you take a look at the two portfolios, one is the overseas portfolio. This at the moment has not contributed any earnings to the to Amara, but we do expect to see significant earnings contribution starting from next year when Amara, Bangkok, and Shanghai become full operational in the year 2015 and 2016. These two overseas projects is estimated to contribute to about 50% of the revenue of hotel and investment management business segment by the time they become fully operational. So in other words, we expect it to kind of double the revenue for the hotel and investment management segment then. From what we understand from the Amara management, actually for Amara Bangkok, they are very confident to actually break even for the project in less than 10 years due to the low land cost they acquired for the land, and of course the operation, the better margins that they would expect to gain then. For Singapore portfolio, despite the upcoming of the new hotels in the Tanjong Pagar area, the portfolio remains resilient with Amara. The Amara Singapore, the flagship assets, continue to perform with steady rapport and a healthy 85% of the occupancy rate. This is mainly due to their strong corporate client base. For the commercial assets, it's enjoying stable rental income with office and retail outlook still going strong with the revision of the tenant mix to optimize the rental yields. So overall, the Amara hotels will seek to stay competitive by focusing on the upgrading of rooms and provide quality F&B service to draw traffic to the premises. As you know, the government is also now developing on the Tanjong Pagar area. So we do expect in future the traffic flow towards the area to increase. So from what we feel, Amara still remains undervalued and has room for further upside share movement with a deep discount to 40% to our current 1.16 RNAV value. So we would like to reiterate on our buy call with the target price of 70 cents. Of course, we do, there is a potential catalyst of a joint venture hotel investment in Yangon. At the moment, we do not have much details on it yet, and our target price actually has not included this. So you can see that there is quite a good potential upside once the hotel investment details are available. Yeah, so okay, that's all for Amara. We will move to our next colleague, Colin, who will cover on Yu Yan San. Thanks.
Hi everyone, this is Colin, and today I'll be giving a brief overview of Yu Yan San International. This is mainly a company that provides the TCM and Chinese medicine as well as some wellness products. So we'll also be giving sharing some insights on the industry outlook as well as where are the potential upside to this company. Right. This is a current snapshot of the company, whereby the share price is last traded at 11th July at about 82.5 cents. Right. Market cap is about over 350 million Singapore dollars. Right. And the last 12 months, trailing 12 months PE is about 20.2 times. Right. So just to give a background of the company, the Yu Yan San is a leading healthcare and wellness company, mainly dealing in traditional Chinese medicine. It has a wide offering of over 1,000 Chinese herbs and medicinal products, which probably makes it one of the company that provide one of the widest offerings in Chinese herbs and medicinal products category. Its origins can be traced back to 1879 in Malaysia. So they, giving it the company has operating for over 134 years, right, in offering TCM through the retail and wholesale distributions. And the company is managed by the Yu family, mainly is run by Mr. Robert Richard and Clifford Yu, which are the fourth generation in the Yu family since the founder and all three are cousins, right? So on the business, Yu Yan San is having a growing and expansion in its retail and distribution network, which operates worldwide, right? It started from a 72 million sales turnover in June 2000, which was the year it was listed on the SGX main board, and now is having a sales turnover of about over 300 million, right? Is last reported in the last fiscal year, and that will translate to about the growth rate of 12.3% in the top line since then. Right, it operates over 300 retail outlets in the following countries: China, Hong Kong, Macau, Malaysia, Singapore, and Australia. And it also, apart from its retail outlets, it also operates over 30 TCM clinics in Singapore and Malaysia, as well as 2 integrative medical centers in Hong Kong. And for its retail, for its wholesale distribution, this extends to the US, UK, as well as Australia, New Zealand, and the rest of ASEAN, right? So just a brief overview on its history. Yuan Sang, it can be traced to its first TCM shop that was established by Yu Kong in Perak, Malaysia. So the business then was to provide TCM mainly to the miners in that region as an alternative over to alleviate the pains and sufferings of the miners. Otherwise, they may have to rely on the opium to alleviate the pain. Right, so that's how the business was started, and ever since then the business grew, and over the years, first it was handed over down to Yu Teng-sen, who expanded the business to Singapore, Hong Kong, and China. After which it was divided into mainly two entities. First is the Yuan Sang Hong Kong, and the second is the Yuan Sang Singapore, Malaysia, right? Whereby they were listed separately in the Hong Kong Stock Exchange and the Singapore Stock Exchange, respectively, right? So for the Yuan Sang Singapore, Malaysia, it was renamed as Yuan Sang Holdings, which was acquired by the Lam Chang Group sometime in 1990. However, a few years later, it was bought back by the Yu family, right? And then in 2000, they were listed back on the SGX main board, right? After which they also prior to that, they also acquired back the Yuan Sang Hong Kong, right, and basically reunited the whole of Yuan Sang TCM business, right. So since then, the company has been growing quite aggressively. In 2006, they also expanded their manufacturing capacity in Hong Kong, right. And in 2012, they have penetrated into the Australian market by acquiring the Healthy Life business, right. So that portion of the business is still growing quite strongly. And in last year, they had two major announcements. First was they had bidded for a new plot of land in Hong Kong that's mainly to expand its production capacity as well as its R&D capabilities. And the second is forming of a 50-50 joint venture in China, Sichuan. This was mainly to set up the plan for better sourcing of high-grade TCM herbs as well, and allowing Yuan Sang to become one of the largest exporter of TCM herbs in China. Right. I'll be elaborating more on these two major announcements in the later slides. Right. So this following slide just gives you a brief overview of the ownership structure. Right. The three executive directors are made of the Yu family, right? With Mr. Robert Yu as the chairman, and he's also in charge of expanding the business in China, right? So group CEO is Mr. Richard Yu, and the group the managing director, who's mainly in charge of expanding Yuan Sang internationally, is Mr. Clifford Yu, right? Most of the shares the majority of it is owned by the Yu family, either directly or through some investment holding companies, and the public float for the company is roughly about 29%, which was reported as of the last fiscal year 13. Right, Yuan Sang mainly operates in 4 business segments, which is firstly is the retail business. Second is the export and distribution network. Thirdly is the clinic services, and lastly is the manufacturing of its products. Right. The retail, it has a strong retail presence, mainly in the countries that are highlighted in the red boxes, which are namely Malaysia, Singapore, Australia, China, Hong Kong, and Macau. Right. So since 2000, it has expanded its retail outlets very aggressively at an average rate of about 17 new outlets a year. Right. For the business in Australia, the outlets can be divided into two, which are mainly the company-operated outlets and the franchisee outlets. This is due to legacy issues, which when it acquired the Healthy Life business. So Yuan Sang direction will be trying to move away from franchisee outlets to the company-operated outlets. Right. So these are the top 5 selling products of Yuan Sang for the last 9 months of fiscal year 2014, right? So this among the 5 products includes 2 of Yuan Sang's flagship products. First is the Powing Tan, which is overall has always been one of the top selling products, right? And the product is mainly used for infant care, mainly for the treating of nasal conditions of babies and helping them to sleep better. And the second flagship product of Yuan Sang is the Bai Feng Wan. These are mainly used for women's care, right, and helping them to cope with symptoms of that time of the month, right. Another product is the bottled bird's nest. This is edible bird's nest, which is also one of the top selling products. However, this product is unfortunately banned in China, so that will actually lead to poor performance of the business in China, which I'll be elaborating more later on. Right, so this gives you an overview of the revenue. Top line growth has been quite very strong over the last few years, right, and has been experiencing near the double-digit growth, right. And her earnings has been, however, quite on the volatile side, right. This is mainly due to margin compression as well as the acquisition of the Healthy Life business in Australia, right. Over the pie chart on the bottom left, you see that close to 80% of the revenue is mainly coming from the retail distributions, and the rest are contributed from the wholesale and the clinic services. On the pie chart on the right shows the geographical breakdown. Hong Kong is one of the main contributor to its revenue, followed by Malaysia, Singapore, and then Australia. Right. So as you can see, that Hong Kong contributes to close to half of Yuan Sang's revenue. Right. So on the industry outlook, right. So TCM is gaining worldwide acceptance and is mainly known to have longer lasting medical effects as well as lesser adverse side effects as compared to Western medicine. Its main use is mainly used for the cardio, cerebrovascular, oncology, and respiratory ailments. If for the benefit of those who are not too familiar with these medical terms, cardiovascular mainly refers to heart diseases and any condition of the blood supply to the heart, and or rather from the heart, and cerebrovascular is mainly relating to blood supply to the brain. So this includes conditions such as stroke. Oncology is a branch of medicine that refers to treatment of cancers, and respiratory includes lung diseases as well, even common coughs and so on. The Western pharmaceutical companies such as Novartis and GSK also began to look into TCM research in 2009 and 2012 respectively. So this is an indication that even the Western countries are getting accepting TCM. Also, this industry is actively promoted by the Chinese government. It's globalizing the TCM. As one example is through the non-profit public institution, which are also called the Confucius Institute, etc. TCM was also exported to 171 countries and regions in 2013 with over 20% year-on-year growth, right? And this is in both the foreign trade exports and the imports, right? If you see the chart on the right bottom, Japan, Hong Kong are some of the top destinations of the traditional Chinese medicine exports, right? Sometime in 2012, right? And also exports of TCM from China is expected to rise by more than 10% a year over the next 5 years from 2012. So these the underlying trends are definitely very favorable to Yuan Sang, right? So more on the business strategies of Yuan Sang. The company is mainly building a strong brand, and they are trying to brand themselves as between the providing curative medicine and as well as health supplements in the preventive and wellness category, right? So mainly, unlike other companies, they will also be providing health foods and supplements, right? And this is where the UNSN wants to position itself in, right? So more on the recent major announcement that was announced in 2013, right? UNSN has bid for the land in Yinlang, Hong Kong, which was situated directly opposite its existing factory in Hong Kong. So this is mainly to expand its production capacity as well as its R&D capability, right? And operations expected to commence in early 2017. So this new factory will have a production capacity that's more than 2 times of its existing facility in Hong Kong, right? So this will greatly expand its manufacturing capacity of UNSong's products, right? The next major announcement was the setup of the 50-50 joint venture with Sichuan Nature's traditional Chinese medicine company, right? So the main purpose was mainly to setting up high quality TCM decoction pieces plant. So this will allow UNSong to upgrade its supply chain, mainly allowing it to become China's exporters of TCM herbs, and this is expected to improve margins due to lower costs of raw materials, and also to boost its wholesale distributions of TCM herbs and medicinal products. Right. So that was all the manufacturing approach of the company. Secondly, UNSong also wished to build up its research and development capabilities through several collaborations with various institutions, right? This includes hospital educational institutes as well as universities, as well as other industry associations, right? It has 2 factories in Hong Kong and Malaysia, right? And these factories have advanced herbs fingerprinting technology, allowing to identify over 500 Chinese herbs, and also is GMP certified, right? So the company is mainly building a stronger branding through infusing TCM knowledge into its health food and supplements, as well as engaging customers through its retail outlet distribution, as well as TCM clinics. Right. Next, on the financials, right? So just going through on each chart. First is the chart showing the gross profit, right, as well as the EBITDA, right? Gross margin has been relatively stable over the last 10 years, which was roughly about 50 to 51%, right? However, on the EBITDA margin is getting slightly compressed over the last fiscal year due to aggressive expansion of its retail outlets. Revenue by regions, if you see the chart on the right, right, Hong Kong has always been the main contributor to UNSong, followed by Malaysia, right? So these 2 regions have experiencing very strong revenue growth, right? For Australia, this was recently contributed through the acquisition of the Healthy Life business in Australia. So the contribution has started since FY12, and this is growing quite strongly. However, revenue from Singapore has been rather flat in recent years, right? On net gearing, right, the chart on the bottom left shows its gearing positions. You can see that UNSong has always had a low net gearing position. However, in the last 2 fiscal years, this has increased significantly. That was due to its expansion plans, and as the company has mainly issued new warrants and notes, and also the issuance of medium-term notes. Right, these are mainly due in 2016 and 2018. Right, so as you can expect that net gearing may increase right during this period and in the near term, right? figure on the right mainly shows its cash flow positions, right? Operating cash flow has been rather stable and increasing steadily. However, on the investment outflows, right, in recent fiscal year, this has increased significantly. And that was mainly due to the expansion of the Hong Kong production facilities, as well as some property acquisitions in both Hong Kong and Singapore, right? Given the company's strategy to further expand, especially in China, you can expect the that the company will still incur significant high capex, right, in the near term, right? Right. On earnings and net margins, right, net margins has experienced a significant margin compression in recent years, which I've mentioned was mainly due to expansion of mainly in Australia, and also this was contributed due to the increase of rental expenses in its retail outlets, right? Dividend payout has roughly been about 50%, right? And although there is room for further increase in payout, you can expect that this will probably be remaining at this level, right, as the company continues to focus on expansion of its business, right? So the chart on the bottom right mainly shows you the same store sales, right? As you can see, Hong Kong, Malaysia, as well as Australia are experiencing very strong performance. However, Singapore has declined over the last 9 months, as China has experienced a poor performance, and this was mainly attributed to the ban on the bottled bird's nest sales, right? So next is a summary of its investment merits and risks, right? On the investment merits, Yuan Sang enjoys the following competitive strength, which is firstly a strong brand recognition. The company has won several awards and accolades, right? And among them includes the Forbes under billion top companies in Asia. Right? Also, the Yuan Sang has a strong regional presence in the following countries: China, Hong Kong, Malaysia, Singapore, and Australia. It also enjoys a wide range of offerings of Chinese herbs and medicinal products, right? And it has excellent R&D and manufacturing strengths, right? Also, another investment merit is a strong management team that has a long-term strategic focus on the company, given the long history of family ownership, right, and interest in Yuan Sang, right? The company also has a good cash flow generation, and they will allow it to support a consistent dividend payout, right? So the summary on the potential upsides of the company is firstly greater demand of TCM and wellness products. This is mainly due to growing population as well as growing influence in core markets. Second will be the boost to margins as well in the wholesale business, which are expected from the upcoming the joint venture in Sichuan. And thirdly, a lift on the ban of bird nest imports into China will also provide upside to the Chinese business of Yuan Sang, right? The ban was effective since late 2011, but however, we are seeing some signs of lifting of the ban, as China has given approval for certain Malaysian companies to export bird's nest to China since December 2013. Right. Key risks of the company will include rising costs from rental as well as a higher staff count, and this will contribute to margin compression of Yuan Sang. Second is inadequate supply of qualified TCM physicians, and this will mainly curtail the growth in TCM clinic services. Right? So do note that demand for TCM clinic are actually rather strong, but however, due to the constrained supply of qualified physicians, right, Yuan Sang is not able to grow strong in the clinic, providing clinic service, right? The TCM industry does have a very strong competitive market. Some of these competitors include listed players such as Hyo Enterprise in Malaysia, as well as Beijing Tong and Wang Tang that are listed in Hong Kong. Also, there are other unlisted players, which includes Ma Kuang and Hock Hua and Singapore. Right. Another key risk is regulatory risk on the Chinese herbs and proprietary medicines and the clinic services, as you can expect that it will have a shift towards a more regulated industry. However, this may not necessarily be a negative thing, as this will in fact help to reinforce public confidence in TCM, right? And the fourth and the last key risk of Yuan Sang is the risk of product defects and contamination, which if it does happen, right, it will have a significant negative impact on the brand, right? So in order to mitigate this risk, Yuan Sang will have to continue to uphold its high quality and control practices, right? Right, so on just a quick summary on the strengths, right? Yuan Sang has enjoyed strong competitive advantage as well as a long-term strategic focus, and as well as it has a good cash flow generation, right? Key risks will include cost pressures from rental and staff count, as well as the constrained supply of qualified TCM physicians, as well as increasing regulatory risks and the possible potential risk of product contamination. Right. However, the business has been growing quite strong due to increasing demand for TCM and wellness, and expected to benefit from expansion in China as well as the joint venture in Sichuan. Right. As of the share price is about 82.5 cents. That was last traded on 11 July, and that mainly translate to about 20 times PE, and based on dividends, the dividend yield is roughly about 2.7%, right? So right, we'll come to the end of the presentation. So right, we will take any questions from now.
Hi, Benjamin here. Analyst covering your banks. So OCBC, just give a brief background first. Our call currently still stands at neutral. Even at the current price, although it's corrected downwards, it's still not a good buy at this point in time because of all the overhangs you have seen from Wing Hang Bank. If you've been tracking the acquisition wise, yes, when on yes, turned unconditional because it's past 50%. But on the other hand, there's a Elliott Capital's hedge fund from US that took about, I think, close to 8% stake. Alright, so that could be a potential roadblock for OCBC's acquisition of Wing Hang Bank. So from that perspective, if they cannot achieve more than 9%, they have to keep the company listed. And to keep it listed, it will sell it down to 75%. So once Wing Hang Bank will not be delisted at that point of time, I think you can see that you can expect Wing Hang Bank's share price to correct down to the pre-acquisition level. So from there, if OCBC has to sell on 75%, I think we might see some hits on their balance sheet as well as their P&L. So because of this kind of pricing pressures, I think, my opinion is that OCBC just be a little bit more cautious on it at this point of time. And on top of that, the acquisition will be likely to be funded by some form of rights issue. right? So which would prove to be dilutive to shareholders. Okay, so OCBC, just be cautious on it, and our policy remains the same, right? Neutral.
Hello, there's a question on Amara on how do we actually get our NAV. Okay, that one is our RNAV of 1.16. It includes the expected, it includes the, sorry. Okay, one thing, it includes the the value of the developed properties and also the developing properties and also the expected ongoing projects, including for the residential projects and everything. So it will include the Shanghai, Bangkok, Shanghai, Bangkok, Amara, Shanghai when completed all these. At the moment, whatever was in the financial statement does not include all these. Thanks.
Hi. Question on under what circumstances do we do non-rated? Call after detailed analysis. I think is when we see that the company has a significant growth plan or story going forward. However, the valuations are not that attractive at the moment, and also there is some execution risk. So it's very much a keep in view kind of thing. Right? We want to know about the company and then we'll monitor it. And I think when valuations are good or the plan is, you can see signs of good execution, then it can be changed to a full initiation. Thanks. Okay, on Ezon, okay, we have a change of analyst now, but we think that although the points raised by Credit Suisse do have some validity, especially in terms of competition and barriers to entry, we do note that the most significant barriers to entry is the operation of a lift boat. Okay, so it's not something that is very easily attained, and Ezon also needed Ezra's backing to attain this kind of level of expertise.
Hi. Shall I repeat that question? The question on Ezon, the answer I gave, because some people said they couldn't hear. Basically, although some of the concerns raised by the Credit Suisse report are valid in terms of competition, we do note that there is a significant barrier to that entry in terms of operating a lift boat. Right? It's not that easy to get the certification to do so, and Ezon did require Ezra's backing to achieve that level of technical expertise.
Hi. There's a question relating on Transpac International. Unfortunately, this is we do not cover these companies, so we're not we do not have any comments or views relating to this company.
There's a request for a comment here on Raffles Medical. We don't cover it at the moment. However, we are looking into it. I think there is significant revenue and profit growth, but not immediate, right? So it basically boils down to developing the extra plot of land beside the present hospital, right, which will significantly increase capacity. And of course, the development opposite Holland Village is another earnings potential. Right now, the valuation may not be fantastic, but I think it's definitely a counter to keep in view.
I have a question on OCBC. So it's when OCBC acquires less than 75% of Wing Hang Bank when share price drop. Why shouldn't OCBC buy back the shares at an undervalued price? No, I think from this perspective is I think that if OCBC acquires up to 90% at 2.02 times price to book, with 125 Hong Kong dollars per share of Wing Hang Bank. So if you can't cross at 90%, they have to sell it down to 75% to maintain a 25% free float on Hong Kong Exchange. So when you do that, right, you purchase $125, assuming it drops 30% also, you'll be making a loss. So even if you buy back, the loss would have been a hit on your books already. Right? Thanks. Any news on UOB that caused a sudden price surge this week? Unfortunately, I knew they were issued a trade with caution by SGX, but there was no news that came out. But I know for Friday it surged above $24. I think currently somehow the market still seems to prefer UOB's ASEAN exposure. But I think going forward wise, the fundamentals of UOB is still pretty solid. Just that on the valuation side, I think it's looking quite stretched really currently. And that's why we have downgraded them previously. Right.
Hi. We note the interest in Transpac Industrial, and I think it is interesting given that it's going into fund management. Could be the only listed fund management entity on the Singapore Exchange. So we are definitely going to look into that and hopefully give you guys an update at some point. At this point in time, we haven't studied into it that deeply, to be honest. Just in case you guys missed my earlier reply on when do we do a non-rated, basically it's when we see that a company has substantial growth ahead of it and a good story going forward. However, valuations are unattractive, then I think we would probably not initiate on it straight off. So it's a keep in view kind of thing. And once valuations get more attractive and if the execution plans, we see signs of it improving over time, then we would probably initiate them on the company. Thanks.
Right.
this is Lucas, covering US and REIT. So there's a question on the Fed chief announced they are trying to taper off and maybe ultimately stop their bond purchase program from October 2014. What will be? I don't think that they would stop bond purchase totally into 2014, but I shall leave this up to the bank analyst to actually break it down for you guys. But I will answer the question on what will be the impact on REITs and bonds. For me, I'll be covering the REITs. So basically, when interest rate rise, the valuation for REITs generally take a tumble downwards, and it really depends on the magnitude of the increase in interest rate, coupled with how investors are looking at REITs itself. So definitely there's an inverse relationship. Interest rate rise, valuation for REITs goes down, institutional investors wants out, and therefore there may be a drop. However, every REIT, especially those that is more actively managed, they do have a certain pipeline of assets that's coming in, and the growth in dividend may far outweigh the potential drop in valuation, and therefore that can potentially make up for the downside on that front. So are they factored in really? As a market as a whole, I would believe that they are partially factored in. I wouldn't think that they are totally factored in already. But the advice here is definitely to look into individual REITs and understand their growth profile. See what the REIT manager is trying to do for the REITs. Any REITs that is stagnant, whereby the manager is just happy to be sitting on whatever assets that you already have and leading a life that's free of such worries, these REITs should be avoided, and you guys should exit. You guys should move more into those REITs that's actively managed as a pipeline. They're actively looking at how to better improve the dividend for the investors. Yep, that answers your question.
I have a continuation of a question on the OCBC. Okay, if there's a hit in the share price down by 30%, isn't it cheap for OCBC to accumulate? Okay, let's always simply first. The acquisition has turned unconditional, so I have to buy $125 per Big Hang Bank share price. Okay, so if I buy up 9% and I need to maintain a 25%, I'll be selling down at probably a 30% loss of the $125 that I acquired at, right down to 75%. And that's why there's really a hit on your P&L, as well as on your P&L, even though you're able to consolidate Big Hang Bank to your books, right, because of the sell down in the investment. So by that, I'm really taking some losses. Okay. So therefore, yes, after you can accumulate it back at a cheaper price, but you already have taken the hit. Okay, and then for OCBC as well, just remember that they definitely have to issue some form of shares to a rights issue, right, to maintain their capital ratios at a healthy level, right, in compliance with the Basel III requirements. Right, so by that, you can really expect some dilution to shareholdings, right? And at this point in time, they still have not officially announced how much equity they're going to issue for it. Okay. And then I have a question on Goodpack earlier as well. Current price 238, acquisition price 245. I think there was some concerns over the roadblocks that they might face because of some early redemption of their medium-term notes. So I think they have about 6 or 7 series of it. And Series 6, which is about 50 million, there's a fund who bought into that, and they wanted a higher payout for the early redemption. So it was not agreed. So at this point of time, they're still discussing on it. But I don't think that 50 million KKR will be able to overcome this small roadblock, only 50 million. So at 238, possibly presents quite a good buying opportunity, but even though we don't have a call on this.
Right, if there are no further questions, right, thank you for listening in. We do want to apologize for the delay in this webinar as well as the postpone of this webinar due to technical issues over the sounds. So do look forward to our next webinar on same time on Monday next week, right?